choose to exit the spread. If the underlying asset closes in between the two strike prices, the short call is assigned and the strategist will be forced to deliver cash equal to the difference between the XAL settlement value and the strike price of the option. Since the XAL settles European style, this can only happen at expiration. If it does, the strategist keeps the premium from selling the spread and the long call will expire worthless. If the loss from the assignment of the short call is less than the premium received from selling the spread, the trade results in a profit. That is, if the XAL settles below the break-even of 53.75, the strategist banks a profit from the bear call spread. The risk of unexpected assignment. It should be noted that significant news after the close of trading on the last day can result in unexpected assignments for non-indexed securities. Let's consider a bear call spread using the Oil Service Holdrs Trust (OIH), which is trading at $133. Assume the short call strike price is $135 and the long call strike price is $140. At the end of trading immediately prior to expiration, OIH closes at $134.90. What would happen if some significant news event is expected to push oil to $200 a barrel? Wouldn't the oil service industry stand to benefit substantially from such a move? A long holder of the expiring 135 call may decide to exercise his or her rights after the close of trading even if the underlying closed below the strike price. Although this is an extreme and atypical scenario, it can happen. Be aware of such a possibility and monitor conditions after the close of the underlying so you can appropriately manage your risk. 82. Covered calls. The index trading course. Covered calls are used to generate cash from selling options on an existing position such as a stock or exchange-traded fund. This popular technique is referred to as a buy-right strategy. In a buy-right, the sale of call options serves two purposes. First, it can bring income to a portfolio via the selling premium. Second, the sale of the call provides some downside protection by decreasing the effective purchase price of the stock or ETF and thereby decreasing the total capital at risk. To create the position, the strategist buys shares and sells calls against those shares. One call is sold for every 100 shares held. The call can be written against an existing position or as part of a new trade. While this strategy is most often used with stocks, we will consider its use on exchange-traded funds. Keep in mind that any combination strategy that uses shares and options cannot be applied to indexes such as the S&P 500 Index $SPX or NASDAQ 100 NDX because these are cash indexes with no tradable shares. However, they can be applied to ETFs, exchange-traded funds. The covered call is also used in one of the enhanced index strategies discussed later in the book. Let's consider an example of a covered call using the NASDAQ 100 Index Trust QQQQ. During the late 1990s, the Nasdaq was a volatile place and the QQQQ, which holds the top 100 Nasdaq stocks, became a manic depressive beast. It would see huge rallies and sharp declines. Volatility was high, to say the least. That has since changed, however, and during the years 2004 and 2005 volatility on the Nasdaq imploded. As of this writing, the QQQQ has been trading quietly. Narrow, range-bound trading is what strategists want to see when establishing covered calls. Ideally, the underlying ETF will see modest capital appreciation over time and the strategist can continue to sell calls against those appreciating shares. If the underlying shares fall too much in price, the trade will result in a loss. On the other hand, if the price rallies, the short call will be assigned. While it will probably result in a profit, the strategist will be taken out of the trade and not be able to fully participate in the bullish move. For example, in March the strategist sets up a buy right with the purchase of 1,000 QQQQ shares for $36.50 a share and the sale of 10 QQQQ June 40 calls for 50 cents a contract. The cost of the trade is equal to the price of the shares minus the premium received for selling the calls, or $36,000 $36.50 minus 50 cents times 1,000 which is also the break-even. Ideally, once the strategist has established the covered call, shares of the QQQQ will begin to trend higher. Figure 5.4 shows the risk graph of the trade. It slopes upward and to the right because the profits increase as the value of the underlying index moves higher. However, at a certain 83. Basic strategies using call options. Figure 5.4 QQQQ June covered call risk graph. Source: www.optionetics.com. Platinum. Point: the gains are capped because of the obligation from the short calls. Once the underlying asset reaches the strike price of the short call, assignment becomes more likely. In this example, the gains max out at the strike price of 40. At that point, the short calls are assigned at $40 a share and the strategist will be forced to sell the stock at that price. Nevertheless, the position realizes a $4,000 profit, which is equal to the strike price minus the net cost of the trade, $40 minus $36 times 1,000. If the shares decline in price, the covered call begins to lose money. Therefore, the risk of the covered call is similar to the risk of owning shares outright, but somewhat less due to the sale of the call options. If the options are deep out of the money, the premiums will be less, but the upside potential will be greater. Selling options that are at or near the money will yield a greater premium, but less upside potential. In the QQQQ example, the premium was 50 cents per contract for an investment trading for $36.50. Therefore, the downside protection from the short calls was only 1.4%. If the strategist sold the QQQQ June 37.50 calls instead, the call premiums are greater, roughly $1 a contract, or almost 3%. The strategist needs to determine which trade-off is more important. The exit strategy for the covered call will depend on the movement in the underlying share price. The worst-case scenario is for the price of the underlying asset to plummet below the break-even. In that case, the strategist will want some sort of stop-loss or price level to exit the position. If the price of the underlying asset remains stable and below the strike price of the option, the strategist lets the calls expire worthless. The shares can then either be exited or be held with the prospect of selling more calls. A strong upward move in the underlying that pushes it above the option strike price will likely result in assignment. If assignment is not the desired outcome, the strategist needs to close out the short calls by entering an offsetting trade. Call calendar spreads. Just as with the covered call, the calendar spread is a trade that can be used when the trader expects a gradual trend or sideways move in the underlying index. However, rather than using shares and options, the calendar spread uses only options. It is sometimes called a horizontal spread or time spread because it uses two options with the same strike price but different expiration dates. In most cases, the option strategist creates a calendar spread by purchasing a longer-term option and selling a short-term option. Calendar spreads can be created when the strategist is neutral or has a directional bias on the underlying index. Basically, in a neutral calendar spread, the trader is taking advantage of the fact that short-term options lose value due to time decay at a faster rate than long-term options. However, strategists can also create both bullish and bearish calendar spreads depending on their outlook for the underlying shares. In this chapter, we consider the bullish calendar spread with calls. In Chapter 6, we take a closer look at a bearish one using puts. To create a call calendar spread, the strategist buys a longer-term call and sells a short-term call with the same strike price. The number of months remaining in the lives of the options contracts can vary, but ultimately, the strategist wants the longer-term option to retain its value or appreciate and the short-term option to lose value from time decay. 84. The index trading course. Vertical versus horizontal spreads. The names vertical, horizontal, and diagonal relate to the way that newspapers use to publish tables of closing option prices. A vertical spread is a trade that involves the simultaneous purchase and sale of options on the same stock with the same expiration date. The only difference between the options that are purchased and those that are. Let's consider an example using an exchange-traded fund. Shares of the utility HOLDRs UTH are trading near $110 per share in October 2005 and the strategist expects the shares to grind higher during the next several months. A bullish calendar spread is created by purchasing 10 UTH January 2006 115 calls for $2.35 and selling the same number of November 2005 115 calls for $1.05. The cost of the trade is equal to the premium paid for the long call minus the premium received for the short call, multiplied by the number of contracts and the multiplier. In this case, the cost of the call calendar spread is $1.30 per contract, or $1,300 total. The debit, or the cost of the trade, is also the maximum risk of the basic strategies using call options. 85. Vertical versus horizontal spreads. Continued. Sold is the strike price. Vertical spreads get their name from the fact that option tables list options vertically by strike price. A vertical bull call spread is an example. Vertical spreads can also be created with puts. Jan. Feb. Mar. 505050 555555 606060. The horizontal spread will use two options with the same strike price and different expiration dates. This type of spread is also known as a calendar or time spread, which can be created with puts or calls. The call calendar spread is an example. Jan. Feb. Mar. 505050 555555 606060 diagonal spreads are a combination of vertical and horizontal spreads. They can include different expiration dates and different strike prices. For example, buying a longer-term call option and selling a shorter-term call option with a higher strike price is an example of a diagonal spread. Jan. Feb. Mar. 505050 555555 606060 86. The index trading course. Calendar spread. It occurs if the share price falls below the strike price of the options and both options expire worthless. Ideally, however, the price of UTH will begin to trend higher. For instance, if the fund rises to $115 at November option expiration, that option will expire worthless. However, the value of the long call should have increased in value as well. On November 18 when the short call expired, the fund was actually trading near $112 and the market for the long call was a bid of $2.05. Therefore, if the short call was allowed to expire worthless, the strategist gained $1.05 on the sale of the short call. This must be netted against the paper loss of 0.30 cents per contract on the January 115 call. At that point, the strategist could 1. Close the position by selling the long January calls and realize a 75 cents profit per spread on the trade. 2. Sell another short-term option such as the December 115 call. 3. Roll the position to a higher calendar, or 4. Simply hold the long call position. Figure 5.5 shows the risk and reward of the calendar spread graphically. The maximum profit occurs at expiration when the price reaches $115 a share at November expiration. At that point, the short call expires worthless, but the long call has appreciated in value and can be sold at a. Figure 5.5 UTH January-November call calendar spread risk graph. Source: www.optionetics.com. Platinum. 87. Basic strategies using call options. Profit. However, the trade loses money in the event of a strong move higher or lower in the underlying index. If shares rally above the strike price of the short option, it will probably be assigned near expiration and the strategist will either buy the shares in the market to satisfy the assignment, or exercise the long option to fulfill assignment. If the share price tumbles, the call calendar spread will result in a loss since both options will lose value and may even expire worthless. The strategist then loses the debit paid for entering into the spread. The exit strategy for the calendar spread determines the success of the trade. The outlook for the underlying index will generally dictate the decision. If the shares remain range-bound and the short call expires worthless, the strategist has 3 courses of action from which to choose. 1. Exit the position. 2. Sell another call. 3. Roll up to another strike price. If the price of the underlying index does indeed remain stable, the best approach is to sell another shorter-term option. In our example, once the UTH November 115 call expires, the strategist might sell a December 115 call. Or the position can be rolled up by purchasing the February 120 call and selling the December 120 call. Sometimes it isn't possible to sell another call. Instead, the share price jumps too high and the risk profile associated with selling another call is not attractive. In that case, the strategist might simply want to close the position by selling the long call. If the shares move against the strategist during the life of the short call, the best approach is probably to exit the entire position when the short call has little time value remaining. If the shares jump higher and the long call has significant time value, it is better to close the position rather than face assignment or buy back the short option. If assigned and forced to exercise the long option to cover the assignment, the strategist will lose the time value still left in the long contract. The strategist can also choose to do nothing when the short call expires and simply hold the long call. This will yield profits if the underlying index moves higher. The strategist simply takes the calendar spread and turns the trade into a long call. As an alternate bullish approach, if the index looks bullish, the strategist can hold the call and sell another call at a higher strike price, which creates a strategy known as a bull call spread. 88. The index trading course. Break-evens on time spreads. The break-even point for calendar spreads is sometimes difficult to calculate since most charting software looks at the break-even price when the short-term option expires. However, at that point, the longer-term option will probably still have value. It is difficult to know exactly what the break-even stock price will be for this type of spread because the strategist is evaluating options with different expiration dates. In these situations, it is best to use options analysis software that will incorporate other option pricing factors to get a general idea of the break-even. Keep in mind that even this approach is not perfect because software can't predict changes in an option's future implied volatility. The best we can do is to calculate an approximate break-even and then plan our exit strategies accordingly. Bull call spreads. The covered call and call calendar spread can generate profits in trending markets, but what about when the strategist expects an explosive move higher? What strategies make sense? The long call has already been discussed. The problem with a straight call is that it is risky. If the underlying index moves in the wrong direction, the trader stands to lose 100% of the initial investment, the premium of the option. In addition, time decay can be a killer when holding long options, waiting for the index market to move. The bull call spread is a vertical debit spread strategy that can help mitigate the risk of a long call. The trade is created by purchasing a lower strike call and selling a higher strike call with the same expiration dates. The total investment is usually far less than the amount required to buy shares or long calls. In addition, the bull call strategy comes with both limited profit potential and limited downside risk. The maximum risk on a bull call spread is limited to the net debit paid to enter the spread. To calculate the maximum profit, multiply the difference in the strike prices of the two options by 100 and then subtract the net debit. The maximum profit occurs when the underlying stock rises above the strike price of the short call, causing it to be assigned. If so, the strategist can honor assignment by exercising the long call, thereby purchasing the underlying stock at the lower strike price and delivering those shares to the option holder at the higher short price. However, the spread can also be closed at any time prior to expiration through an offsetting trade. The break-even of a bull call spread is calculated by adding the net debit to the lower strike price. 89. Basic strategies using call options. Let's consider an example of the bull call spread using the Internet HOLDRS HHH. Technology stocks often perform well during the fourth quarter and Internet stocks are no exception. In fact, October is often a turnaround month, and in this example the strategist expects the scenario to play out again. To capitalize on this move, the strategist sets up a bull call spread for HHH, which is trading near $60.50 a share. This is accomplished through the purchase of 5 January 2006 60 calls for $3.75 and the simultaneous sale of 5 January 2006 65 calls for $1.25. The cost of this spread is $250, $3.75 1.25 times 100. Since the trader created 5 spreads, the net debit is $1,250, $250 times 5. Figure 5.6 shows the risk graph associated with this spread. The maximum risk of the bull call spread is equal to the debit paid for the trade and occurs if all the options expire worthless. In that case, the strategist eats the cost of the trade, which is $1,250 in this example. The maximum profit occurs at or above the short call strike price. If HHH rises to $65, the January 65 call expires worthless while the January 60 call is worth minimally $5 per contract, or $2,500 for 5 contracts. Therefore, the maximum profit is equal to $2,500 minus the debit of $1,250, regardless of price movement beyond $65. The maximum profit of a bull call spread is always equal to the difference between the strike prices minus the debit and occurs at or above this higher strike at expiration. Figure 5.6 HHH January bull call spread risk graph. Source: www.optionetics.com Platinum. 90. The index trading course. The bull call spread is one of the first strategies we teach, and it works well when the market trends higher over a period of time. However, just as with any strategy, a few guidelines are in order. Strategists should focus on options with at least 60 days until expiration in order to give the underlying stock enough time to move into a profitable position. Extremely short-term bull call spreads provide the most leverage, but also provide less time for the trade to work in the strategist's favor. Longer-term bull call spreads have more time to work in the trader's favor. Keep the net debit as low as possible to make the trade worthwhile. We often look for ratios of 1 to 3 or more. That is, for every dollar that is at a risk, the trade has the potential of making 3. In the HHH example, the ratio is 1 to 1, i.e., for every dollar at risk, there is $1 of profit potential. To increase the ratio, the strategist can look at out-of-the-money options or wider spreads. In sum, the difference in the strikes should be large enough so that the maximum profit is worthwhile. Finally, when exiting the trade, the strategist will want to consider a few factors. Ideally, the price of the index will move above both strike prices near expiration and the spread can be closed out at a profit. However, if the short call is assigned, the long call can be used to honor assignment and bank the profit. If the underlying asset price rises up toward the strike price of the short call, but does not exceed it, the long call can be closed at a profit and the short call can be allowed to expire worthless. On the other hand, if the market tanks, the strategist will want to exit both of the positions. If the price of the underlying index falls below the strike price of the long call near expiration, the spread might expire worthless, creating the maximum possible loss on the trade. A note about trading levels. Now that we are talking strategies, traders will want to keep in mind that not all brokerage firms allow clients to trade high-risk strategies such as naked call writing. In fact, some won't let traders establish any type of spread. In order to understand why, traders need to understand how brokerage firms view options trading levels. 91. Basic strategies using call options. Prior to trading in an option account, brokerage firms require clients to complete an options approval form. This form is designed to provide the brokerage firm with information about the customer's experience, knowledge, and financial resources, and is required for compliance with federal regulations. According to the Know Your Customer rule, option trading firms must completely minimize the potential for clients to take inappropriate risks. Therefore, the new account form and the options approval document gather appropriate background information about each customer. The compliance department within the firm reviews the information in order to determine whether the client has attained a certain level of experience in trading before allowing them to open accounts and place more complex trades. The process is designed to protect inexperienced traders from taking inappropriate risks. For example, if the option approval form reveals that the client has little or no options trading experience, and the client then goes on to lose large sums of money via complex, high-risk trades, the brokerage firm could potentially face regulatory and legal troubles for not knowing its customer. Each and every brokerage firm is required to understand the client's background so that new traders are not taking risks outside of certain parameters of suitability. Once the firm has considered the customer's background, the client is assigned a trading level. For instance, Level 1 strategies include relatively straightforward approaches such as covered calls and protective puts. More complicated trades, however, require a higher level of approval. Table 5.1 shows a typical breakdown a brokerage firm might use to group strategies by levels. Traders with a great deal of experience and significant financial resources can generally receive approval for Level 5 trading. This would allow them to implement any type of trading strategy, including high-risk trades such as naked calls and uncovered straddles. Although the options approval levels can vary from one broker to the next, Level 3 as described here is sufficient for the strategies discussed in this book. Uncovered selling of options, which requires approval beyond Level 3, is unnecessary. Nevertheless, in order to avoid the frustration of opening an account with a firm that will not allow trading in more advanced levels, new traders should review the brokerage firm's policy regarding options approval before opening an account. The best way to do this is to contact the firm's options approval department by phone and ask them if they will allow you to trade strategies such as long calls, calendars, and bull call spreads. 92. The Index Trading Course. Table 5.1 Typical brokerage breakdown of strategy levels. Options trading level. Strategy. Level 1, Level 2, Level 3, Level 4, Level 5. Covered call writing, Chapter 5. Square root, square root, square root, square root, square root. Protective puts, Chapter 6. Square root, square root, square root, square root, square root. Buying stock or index puts. And calls, Chapters 5, 6. Square root, square root, square root, square root. Covered put writing, Chapter 6. Square root, square root, square root. Spreads, Chapters 5, 6, 7. Square root, square root, square root. Uncovered writing of equity puts. And calls, Chapters 5, 6. Square root, square root. Uncovered writing of straddles. And strangles, Chapter 7. Square root, square root. Uncovered writing of index puts. And calls, Chapters 5, 6. Square root. Conclusion. The stock market moves higher roughly 2/3 of the time. Therefore, more profit opportunities exist trading to the upside rather than to the downside. In addition, a number of bullish trades can be created using call options. When looking for short-term aggressive moves higher, traders should focus on buying calls. However, the risks associated with long calls can be significant because a move in the wrong direction can result in a 100% loss of one's investment. Time decay can also be a killer. Bull call spreads work better in a bullish market when the trader has a longer time horizon of 60 days or more. Call calendar spreads can work well when the strategist expects a modest move higher or even sideways action. If the market is expected to fall, a bear call spread can be employed to make a profit. However, the bear call spread is not the best strategy for a bearish market. Instead, the strategist might want to focus on strategies that use puts when the market is expected to trade lower. These strategies are discussed in Chapter 6. 93 Chapter 6 Basic Strategies Using Put Options. Chapter 5 introduced a variety of strategies that use only call options. Now let's flip things around and look at strategies that use only put options. Since puts increase in value when the price of the underlying index falls, it makes sense that many of these strategies are simply the opposite of those discussed in Chapter 5. For example, if the strategist expects the market to fall next week, a long put on the SPDRs makes sense. In short, each strategy should be used according to what the situation dictates. A basic understanding of each strategy will help traders by putting more tools in their trading arsenals. The long put. The put option